So you have dominoes falling, boom, 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 boom. You know that the last one's going to fall unless they drop a steel wall between two dominoes. Now the domino hits when the next one doesn't fall. That's what they did in September of 2008. If you're listening to Michael Burry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's a triple greatest bubble of all time times 3, in the sense that it's real estate, stocks, and other asset classes. So I do, that is my view, but it's shared by a number of other analysts. They look at it, US objectively, okay, our debt to GDP ratio is over 130%, the highest in US history. At those debt to GDP ratios, you can't grow. You can maybe refinance and muddle through, but it always ends either in default, which is unlikely because we can't print the money, that much is true, or extreme inflation, where here's your $1 trillion back, good luck buying a loaf of bread. So we'll see how that plays out. But the way it's playing out in real time is that the US economic growth is incredibly weak. There was a solution on the table that they never pursued because of cronyism. See, now we're getting into the gangster side of it, the cronyism side. So what they should have done, by executive order, and the legal authority was there, they could have nationalized all the big banks. Not permanently, because I'm not in favor of socialism, but temporarily nationalize it. Clean it. What you do is you wipe out the equity. First of all, you rip out the bad assets and you put them over here in trust for the American people. So it might take 20 years to sell them, but whenever we sell them, that money goes to you, the taxpayers. Over here, we now have a clean bank. Equity, you're wiped out. Bondholders, how big's the hole in the balance sheet? 20% haircut, 40% haircut, whatever it takes. Preferred stock, you're probably wiped out. Put the losses where they should be. Put the losses on the people who deserve it, which are the stakeholders in the institution. So now you get rid of the bad assets, you wipe out the equity, you now IPO a clean bank to raise new equity, and you start over with Citibank and Goldman, all these guys private, with new owners and clean balance sheets, and we can get the economy moving again. That is not what happened. What did they do? They took the TARP money. By the way, TARP was the greatest bait and switch in history, because Hank Paulson, our Secretary of the Treasury, went to the Congress and said, I want this money so I can buy the bad assets for the banks. I want to strip out the bad assets. That's not what he did. He took the money and gave it to the banks as capital, and they kept the bad assets, which meant that when they recovered, the bankers got the profits, not the people. So this was cronyism as first. Nobody went to jail. None of the big banks failed, other than the Bear Stearns. 1929, everyone was like, yeah, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years. But that fell 82%. And that happens. So yeah, we're down, NASDAQ's down, bounced back a little bit in recent days, down close to 30%, down, the S&P down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, full, market adjustment looks like in the face of the kind of recession that I expect. Whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and orders have been slashed, you're not moving anything by truck. So there are certain businesses that are concurrent, but the stock market is saying, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out. This is the soft landing Goldilocks scenario where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's like Wall Street always ends every analysis with buy stocks. So now we're dangerously close to the point where as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. The crisis is the dollar itself, and there's no way to bail out a dollar crisis with dollars. Then where do you go? And a lot of this is dollar related. All the other countries, I mentioned Switzerland, India, China, Japan have all seen their U.S. dollar reserves go down, and everyone's like, "Oh, they hate the dollar. They're dumping the dollar." No, it's the opposite. They don't have enough dollars, so they're selling treasuries to get dollars to bail out their own banks because there's a dollar shortage. So the fact that you see those dollar reserves coming down does not mean that they hate the dollar. It means that they need dollars, that they're short of dollars, and they're so desperate that they are selling treasury securities to get dollars to bail out their own banking systems. The Fed's thinking it could be early to mid 2024 before they even think about cutting rates. That's the famous pivot. So here we see Wall Street in real time kind of bidding up tech stocks because the Fed's going to pivot and cut rates. When in fact, Powell's thinking, no, that's not happening until 2024. So that's what the Fed thinks is happening. The market thinks that Powell is over tightening, that inflation will come down faster, and the pivot will happen sooner. And that's why we've seen a little bit of a rally in stocks recently. So you have the Fed narrative, that's plan A. You have the market's version of what the Fed's actually doing, which is plan B. My estimate is that they're already past the terminal rate. They don't know it. They don't think so, but they are. And as I said, inflation is going to come down a lot faster than anyone expects.